Yeah, hi, welcome. I've got a topic for you now, which is one that a lot of people ask about, which is investments. We're talking about collectives, collective investments. And we're in the IFA world here, of course, wealth managers world. We're not in the mortgage world at all, although there's a few connections going along the line, because back in the day, interest-only mortgages required an investment alongside, and many of these products were used for that purpose, but not anymore. No, nobody does interest-only mortgages with an investment alongside anymore. That went years ago. It may come back again in the future. But the point is, though, in your exams, you need to understand about investments or collectives. Now, what I've done to help you out here is I've put all of the collectives along the bottom here. I've got 6 for you, the famous 6, the collective 6, I'm calling this one. And these are all collectives. Now, a collective, remember, is where you want to invest in assets, so stocks and shares, government gilts, bonds, property. You want to invest in assets that normally you wouldn't have access to because you haven't got enough money or you haven't got expertise or something. So with your small amount of money, you club in with everybody else and collectively you invest in these products. And there's 6 really that we need to be aware of. And what I've done is I've given us 4 headings, if you like: term, risk, return and tax for each of these. And what I want to do is just go through these with you and give you an idea. And there's a nice little aid memoir which you can possibly photograph to give you some ideas about how they work. So, starting from the top, which seems like a good place to go, at the top here I've got investment bonds. Now, an investment bond is an investment with an insurance company. We often call them insurance bonds, investment bonds, with profits bonds, whole of life bonds. It's called different things, but they're essentially you giving an insurance company a large lump sum of money. Regular premiums would be more endowments or whole of life policies, but an investment bond is a lump sum investment into the insurance company's coffers. Now, they invest the money for you. They have their funds, their insurance funds, which they use for these purposes. They could be with profits funds or unit linked funds, doesn't matter. But the fact is they do the investing for you. So, term, first of all, what's the likely term for this kind of investment? Well, we're talking a reasonable time period. We're not talking short term for any of these products, really. So we're talking 5 years plus. So you could have medium, long, short term. I would probably call these sort of more medium term products, medium to long term probably. So 5 years plus, 10 years plus would be the best place to put your money in, because they're investing in shares, they're investing in government gilts, they're investing in property. These are, big assets that require time for them to mature and do really well. What's the risk then on an insurance bond or investment bond? Well, again, you could have low, medium, high. They're not low risk, they're not like cash, but they are low to medium. So I'm going to put that in there for you, low to medium risk. You can have a with profit bond, for example, which is quite solid and secure. These guys don't take any risks with their investments. They're generally managed funds. They're managed by professionals in a variety of collectives, and they don't like to storm ahead. They like to do slow and steady, which is the way they work. So what's the return then? Well, there's a couple of ways you can get a return. The main way is growth. The fund grows, your proportion of the investment grows. So you put money into the insurance fund and it basically grows, either with units being added or increased, or with the with profits fund just growing with accumulated bonuses and good things like that. So there's growth. So when you take your money out in 5 years, 10 years, 15 years time, your money's gone up. That's the whole point behind it. But you can take an income from it. You're allowed to take up to 5%, known as withdrawals. Now, if you take a withdrawal, you're not paying tax at the time, and that's the key point about it. It's basically just 5% of your original capital you're taking out, which makes sense. Now, tax is very unique here. The way it works is that the fund that is accumulated is taxed at source. Not a lot of people know this. A lot of people think it's tax-free. It's not. It's taxed at source. Special rates tax, capital gains, they've got to pay income tax, dividend tax. The fund has shares, property, cash, gilts in it, and the fund managers have to pay the tax as they go along, and they basically take the money to pay the tax out of the fund. But it's declared as a basic rate. So what it does is it eliminates any basic rate tax liability. However, when you take the money out, there is high rate and additional rate tax liability to pay. So high rate taxpayers, additional rate tax, have to pay extra, the extra bit of tax, 20 or 25%, because they do. And then there's all sorts of things called chargeable gains and top slicing, stuff like that, which you can get into from later videos that we've got for you. That's the basics of it. So a nice investment. Don't really do so well anymore. They used to pay big fat commissions, you see, back in the day. So a lot of the banks would transfer people from their sort of deposit accounts into bonds to make big 5, 6, 7% commissions. It all stopped with RDR. Funny that, isn't it? Anyway, let's go on to investment trusts next then, which is the next one for you. Similarly named, but very, very different vehicles. An investment trust is one of the oldest types of collectives known, actually. They were around in the 19th century when we were creating our empire and we wanted to build railroads across the empire and raise money, and they raised the money through investment trusts. Now, an investment trust is a business, it's a company listed on the stock exchange, so they're pretty big affairs. And the idea of the investment trust is that they buy and sell shares in other companies. That's how they make their profit. So they've got people in an office somewhere, all probably working from home under lockdown, but they're in an office on computers and they're just buying and selling shares in a certain geography, certain sector or whatever, and they make profit. And because they're a company, just like British Airways is a company, they will declare profits and dividends and all sorts of good things. So it's a share, that's all it is. But the company invests in other people's shares. So what's the appropriate term then? Well, we're talking here long term, really, medium to long term. You need to be putting your money in that. You need to be buying those shares because you can sell the shares on the stock market. So if you want to get rid of them, you can do that easily. And you might make a bit of a gain, but the whole point is to keep them for the long period. Good news is, of course, that the managers in the company never have to pay your money back. So they take a very long-term view on the investment and often take a bit of a risk because they've got a long time frame. So the actual risk itself is more medium to high. And we could say high. It depends on the fund and where the money's invested, what geography, what type of company, but it's leaning on the high risk. That tends to be how the exams look at them as well. So what's the return on these things? Well, it's a share, isn't it? So you're going to get capital growth on the share, and guess what else you'll get? You'll get dividends because you own a share. That's all it is. Now, if they make profits, they pay dividends. If they do well, they'll grow in value and the stock market will increase the value for you. And if you sell them, you get a higher value for them. Remember, these are closed funds. In other words, they never have to pay your money back. Well, not normally anyway. So if you to get your money back, you have to flog that share on the stock market, which is why, of course, they take a long-term view. Tax, exactly the same with share taxation. Just to remind you, of course, if there's growth, you have capital gains tax to pay. So you can't get out of that. And you have your exemptions, etc. Of course you do. On the dividends, they're taxed very uniquely now. Dividends, you get your £2,000 free. We know that, don't you? And then you have the 3 different rates for basic rates, high rate taxpayer and additional rate taxpayer. Check it out on the tax sheet for you. But 7.5%, 32.5% and 38.1% for the 3 different taxpayers, and you just basically got to pay the tax. No big deal there, you just got to do it. That's known as the dividend tax regime. But check out the rates, so there's percentages above that. Easy peasy, really, isn't it? Let's get on to unit trusts now and OEICs, which are slightly different. These are not shares. A unit trust is a pure collective, a bit old-fashioned now. And the whole point about the unit trust is that you invest in that product and you buy units, and those units go up or down in value. Run by fund managers, they're operated by a trust effectively. There's charges involved, of course. There's charges in all these things, of course there are. Nothing's done for free, is it? Apart from online apps, but they're a very different story. The unit trust, therefore, is quite a popular one. Term-wise, you're talking here medium to long, really, depending on the unit trusts that you purchase, be they in Bangladeshi stocks or UK stocks or Australian gold mines or whatever it is, determines the risk. And risk, therefore, is more medium to high, really, medium plus. You can possibly get a low risk one if you're putting your money into government gilts. There are fixed interest unit trusts that just invest in government gilts. Some invest in property. Most tend to do shares and things like that. So that tends to be the medium-y sort of thing there. Growth, well, very similar to investment trusts. You have capital growth in your units. In other words, the value of your units may increase and they may decrease. But the big difference here is if you see your units going up in price, which is great, you can flog them back to the fund managers who have to pay you the money back. So they have to find the cash to pay you. This means they're open-ended. The fund can grow, it can contract very quickly. So if everybody wants their money back, for example, the fund will contract. But if they're really popular, the fund will grow. So the fund managers have got to have one eye or one ear open for withdrawals, people wanting to cash their money in. So you can see growth therefore. You just cash in your units, you make a profit, and that's where people tend to make their money. However, the unit trust will pay a return, an income, but they call this distributions. There you go, distributions. This is a play on terms, really. It's dividends that the shares in the fund are paying, but they of course turn these into distributions. So the unit trust, remember, under the banner, there's lots of shares being bought and sold. They will pay dividends. You can't stop a share from paying a dividend unless you have COVID lockdown. They all decide not to pay them, don't they? But most shares pay dividends for a long period of time. And they call them distributions. You can have these sent to you in the form of a bank transfer, or you can have them sent to you and then put back in to buy more units. They call those accumulation units, distribution units and accumulation units. The accumulation one is where you're paid a distribution, but it's used to buy more units for you. So you don't actually see the money, but you have to declare it effectively. That's the next thing, is the tax. Taxation, very similar to the investment trust. You've got capital gains tax, can't get away from that, on the growth of the units. You've also got the dividend regime then, so you've got 2K free, and you've got the percentages in exactly the same way as before. Bear in mind, even if you have an accumulation unit trust where the distribution's paid but they buy more units for you, you're not rolling over the tax liability. You've got to pay it because that's the way the world works. So that's unit trusts. Unit trusts have been around for donkey's years. Donkey's years. I used that phrase in America last year and they didn't no idea what I meant, donkey's years. Probably UK, wasn't it? I also talked about having a shed full of information. They didn't know what that meant either. Different phrases, isn't it? Now, unit trusts have been around for a long time, heavily criticised for their charging structure and their confusing nature and old-fashioned nature. So along came the new kid on the block called OICs, Open-Ended Investment Companies, OICs. They came along in the mid-90s. I remember them coming out, actually. They evolved from the European Union, like a lot of these things. This OIC thing came in to try and eradicate some of the problems of unit trusts. First of all, OICs were available across all European nations, so you could buy and sell them across Europe as well. Whether that's going to continue with the Brexit deal, who knows? Down to the negotiation, isn't it? But what they also decided is clear up some of the charging structure. And they got rid of the phrase units, they got rid of the phrase trust. The OIC is effectively managed by a company. That's why it's called an open-ended investment company. But it is a unit trusty kind of makeup, but they don't have units. Instead of buying units, you buy shares in the OIC. So it's a little bit odd to understand, but it's basically a unit. But there's no different charging prices. There's different charging structure built into the OICs. Essentially, there's no separate prices for bid-offer spreads. You need to check out the individual videos to find out more about that. But not cheaper, but easier to understand, really. Other than that, they are identical. So all I need to do here is ditto. Ditto, 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 ditto. How easy was that? Because effectively they are the same thing. In fact, most unit trusts have converted to OICs anyway because they can and they did, and it's a better deal. So that's where we get those from. Probably. They're the majority of investments that people get into. Let's get down to the bottom two then. The REITs. I like REITs. REIT stands for Real Estate Investment Trust. Real estate, of course, is an American term for property and land. Real Estate Investment Trust. An investment trust, as we've decided, is one of these companies up here that invests in shares. So all REITs do is they are investment trusts effectively, but they invest in real estate. They invest in property, in commercial property, buy-to-let property, big shopping precincts, office blocks. REITs investors in a very tax efficient way. They've got a nice little setup really where they can not avoid, but they can be very tax efficient in the way they operate. Very similar in a way really, because their term is sort of medium. Again, you're not talking about short-term investments here, medium to long. Their risk again is medium to high. depending on the kind of property that's underneath there. There's one I read about recently called the Mailbox in Birmingham, which is a big sort of complex of car parking, a little bit of residential, I think, commercial and retail. And it's owned by one REIT, or one REIT owns the whole of the mailbox. So that's quite risky because you're putting all your eggs in one basket there, aren't you? Whereas most REITs tend to own a variety of properties to give you a collective sort of balance. So the risk can be quite high depending on the investment. The return's very different as well. The return is growth because you have an investment trust effectively, but you also get income. You get income from these ones as well. And it's called income because income from property is different from shares, isn't it? Income from property is rents. That's the difference, really. Taxation's very different. You get capital gains tax for individuals, so that's easy peasy to work that one out. But the income is normal income. So you're talking about 20% tax deducted because it's interest, isn't it? It's, well, not interest, but it's a return. It's a rental return. So it's basically worked around income, really, when it comes to it. So it's 20% for basic rate taxpayers. Higher rate taxpayers, additional rate taxpayers have to pay some more. So think of the interest regime for that one. That's slightly different because it's real estate. They pay rents. Rent is an income. Income is income tax. It's not shares or dividends. Makes sense, really, when it comes to it. That's REITs. Quite like REITs, actually. Good investments. Again, if you don't want to buy to let, you buy into REITs. Not as exciting, I suppose, but a good balanced investment. Which leaves the best till last, which is ISAs, individual savings accounts. You know about these things. You've probably seen previous videos on these topics, ISAs. Now, it depends on the type of ISA will determine what's going on here. And there's three types of ISAs here to think about. There's the stocks and shares ISA, there's the GISA, the junior ISA, and there's the innovative finance ISA. These are the three now that we have available which invest in shares effectively, or kind of high risk assets. Now the ISA itself merely wraps itself around one of these things. It's not an investment in its own right, it's a wrapper, it's a cloak that cloaks an investment and makes it tax free. So the whole point about the ISA is it's tax free. There's no capital gains tax to pay, there's no income tax to pay, there's no dividend tax to pay. The whole lot's tax free. But there are limits, of course, to it. The tax year determines the limits. The limits range from about sort of £9,000 for the junior ISA up to £20,000 for the ISA itself, the stocks and shares ISA. The innovative finance ISA invests in peer-to-peer lending, so it's a similar kind of thing, but very high risk. So it really depends, therefore, the risk on the underlying investment that we're talking about here. The underlying investment determines the risk because it's not an investment in its own right. So, for example, you might have a load of unit trusts or OICs, and what you do is you wrap them with an ISA, with the ISA company or the unit trust company has ISAs, or you can wrap them up. And as long as it's less than 20 grand a year, it's all tax free. Term is the same. Again, that determines the underlying investments. It's the underlying investment will determine the appropriate term. We're not talking about cash ISAs here. Cash ISAs are very short term, nil risk normally, and they pay interest, or there's no tax to pay. But we're not talking about cash ISAs here. We're talking about collectives, aren't we? Return is the same. It's growth and income, again, depending on what you've got. That's pretty much what the ISA is. Remember, it's not an investment. It's a wrapper. A bit like Harry Potter, you know, he had this little blanket he put over and made himself invisible. Same thing, you just put this blanket over an existing investment and you make it tax-free. How cool is that? Can't get much better than that one, can we? So there we have quite a big descriptive overview of the 6 types of collectives, really. Obviously, there's more information under the hood, so have a look at the individual videos for these products. There's charge structure to understand, really, that gets tested. But broadly speaking, these are the kind of information you need. In the CMAP exam, it'll ask you about, it'll compare the different products and it'll ask you questions around risk, around return. Tax always gets questioned as well. And hope that's been of use to you. Bye.